As for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
That was Jerome Powell speaking after the Fed's last rate decision of the year. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to your top stories today. Powell's caution there on rate cuts next year, putting, well, a lot of pressure on Asian stocks and treasuries. As you can see here on my right, the dollar is rising to its highest level in more than 2 years.
Lots of central bank action. We've got the BOJ as well expected to keep rates on hold as expectations grow for a hike next month.
And Chinese government bonds back in the spotlight. That's after the central bank again signaling some discomforts with a record-breaking rally.
All right, this is the market reaction we're seeing to the Fed this morning, but also something that's complicating factors are these debates that we're seeing around the debt ceiling in the U.S. And on that point, we've just had some breaking news crossing the terminal this morning that the House Majority Leader, Steve Scalise, says that the current stopgap bill is officially dead. There is no new deal just yet. We do know that President-elect Trump is pushing for a debt vote. We could see a partial government shutdown in the U.S. as soon as this weekend. So we'll have all the details on that just ahead. But shifting back to the market focus today, because as I said, it's really around the Fed. We actually saw the worst market reaction following a Fed decision going all the way back to 2001. Suffice to say, you're really feeling the pain across equities here this morning. You've got the ASX 200, for instance, the laggard declining the most, down 1.8%. But really, equities are feeling the brunt of this. Really, of course, down to what else we saw in the bond space. Let's take a look, because particularly at the front end of the curve in treasuries, we did see yields really moving high here. You do have that reaction again coming across, particularly in Australia today, most notable the 3-year yield there. New Zealand not really feeling it as much, but we did just see the country falling into recession. Currencies, of course, one to really note. We just mentioned there in the headlines, we've seen the dollar gauge shifting back to a 2-year high or holding around that 2-year high. Again, you do see that reaction in the session today. What else we're tracking, of course, is the Japanese yen. We do see that move looking a little bit different. We do have the BOJ decision just coming up in the next couple of hours. Bitcoin as well, did see it there, but it has been pulling back. And then, of course, watching the Korean won, again, it's that story of dollar strength that's coming in. Stocks-wise, not just the focus on the reaction to the Fed, of course. Micron was the big decliner that we saw after hours. You can see that drop there, 16%. In the red, of course, it is that story around weakness, not in the AI space. That remains strong, but the concern is still around that legacy chip technology, chips that go into things like smartphones, into PCs. And again, you see that read across in the session today, not helped, of course, by the Fed moves. But let's take a look at what's happening for the China setup today. Big watch on what's happening with the 10-year yield. And what is interesting, Dave, of course, we had that PBOC signals. Maybe they're not so happy with that rally that we've seen. But what could be interesting is that read across, again, going back to the Fed, do the moves that happen in Treasury sort of put a floor under where yields go for now?
Well, it's a blessing that came, and I think to the point the other point you were making there, you know, the massive adjustment we're seeing in markets, justified or not, is a blessing I guess Chinese officials will welcome as they try and really, it's a very difficult balance, right? It's a signal of easing, but you don't want rates to fall as much. Bell there, of course, with the market action going into the session today. And just for context, right, the 10-year yield in China, I think, fell something 30 basis points over the last 2 weeks or so. Now, a lot of that also has to do with the fact that you're getting the dollar, which up until recently was showing signs of exhaustion. And then we took out and we, again, exhibited another bullish break earlier on. A lot of that had to do, too, with the new dot plot that came out. So I'll make this very, very simple. You had one cut. We're done with that. Well, you had the first one of the cycle. We had one overnight. You have 2 more based on the dot plot going into next year. 3 cuts is what the market's pricing. And then you have a few more 2026 and 2027, but that's too long away to really extrapolate that far, given the information we have right now. We also did hear from the chairman himself, Jay Powell, on the policy outlook. Have a look.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher, You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
Let's bring in the former Fed Vice Chair, Alan Blinder. He's currently Professor of Economics at Princeton University. And Alan, I think we got a bit of a sense of your reaction just as we were talking to you in the ad break there. But suffice to say, you think that maybe we've got an overreaction in markets this morning.
Way, way overreaction. Many years ago, I coined the aphorism that in calm markets, they generally react 3 times as much as they should. And in panicky markets, they react 10 times as much. This looked like a 10 to me. If you divided the movements in I should have said at the outset, the direction is usually right. So if you took the decline in the S&P, say, today and divided by 10, that would strike me as a rational reaction to the slightly hawkish news that the market got.
Yeah, Alan, David here. I think maybe to your point, and hopefully this continues for the bulls. I mean, S&P futures currently in the Asia Pacific are steady, which might indicate there is some buying taking place. How do you think markets should have interpreted everything that took place out of that statement and also the briefing out of the Fed chair?
I think they should have read it slightly hawkish, but I would emphasize the slightly. This was not a big change in the Fed's stance or their attitudes about inflation. It was a reflection of 2 underlying realities and maybe a third. The 2 that are clear is that the economy, the U.S. economy, has been growing more strongly lately than most people would have thought 6 and 9 months ago, certainly that the Fed thought 6 or 9 months ago. And so growth is higher. Secondly, the steady down of the inflation rate seems to have stopped in the last few months. That doesn't mean we're worried about an acceleration of inflation back to 7% on the PCE. Nothing at all like that. But instead of sort of falling every month, it's sort of constant and rising the last few months. That also argues for less Fed rate cutting. So those are the 2 fundamentals that the Fed looks at when it talks about being data dependent. The third thing, which may be on some people's minds at the Fed, but they would never say out loud, is President-elect Trump's promised policies, and I emphasize promise because who knows what he'll actually do, are very clearly inflationary. I don't mean hyperinflation. Again, we're not going back to double-digit inflation or anything like that, but somewhat inflationary. I'm talking about tariffs and restrictions on labor supply and things like that. That's in the back of the Fed's head. It's something the central bank is not going to talk about.
Yeah, it seems like, and to quote Enda Curran here, who was on our blog about this, but there's a lot of different loose ends as we head into 2025, not just about the outlook for inflation, also, as you said, about the outlook for Trump tariffs and the inflationary impact of those. Do you think there's a chance then that maybe there's even fewer cuts than 50 basis points of easing?
There is a chance. As I said a moment ago, nobody knows what Trump will actually do. He has a lot of authority over tariffs. It's a bit of a disgrace that the Congress has ceded to the president that much authority over tariffs, but they have, and he has it. And while he's not usually worried about obeying the law, in this case, there's no question about violating the law. He has the authority to do more or less anything he wants to with tariffs. What we don't know is what will he actually do? I mean, will he have a call with the Chinese and they'll say some nice things about how good he looks on TV and he'll decide not to go lightly? Or will they do something that makes him a little angry and he'll go much more heavily on bigger tariffs? I have no idea. I think it's anybody's guess.
Yeah, and Alan, I think, you know, you're one of the very few people who can take us inside that room and just help us understand how the Fed looks at something as binary as this. To your point, we don't know if he's going to actually push through with it. But do you think there will be, this might push some FOMC officials to lean more hawkish than they would otherwise, really, given the threat of most of the things I can see on the horizon are inflationary.
Yes, I do, but I want to emphasize what I said before, but not talk about it in public. The last thing a central bank wants to do is to second guess either a sitting president or someone who's about to be president. So they know Trump got elected. They know what he's saying about tariffs. It's got to be on their mind, and they know tariffs are inflationary, even if Trump says they aren't. So it's got to be on their minds, but not on their mouths.
I want to go back to some breaking news that we had at the top of the hour from the House Majority Leader, Steve Scalise, who said that the current stopgap bill is officially dead. There's no new deal just yet, but there is that question and there's that push from President-elect Trump to raise the debt ceiling. How is that also going to complicate the Fed's balance sheet runoff then?
I think probably only a little bit. What usually happens with this, as you probably know if you've been watching this for years, is at the 11th or sometimes the 13th hour, a settlement is reached, and they kick the can down the road for a few months, and then they argue about it again. That's by far the best guess about what will happen this time. It was good news yesterday, I think it was yesterday, that they had reached an agreement. I said, boy, that's nice. There's still 24, no more. There's still like 48 or 72 hours to go. That's a little early for the Congress to settle it. And it turns out that while they settled it, Trump unsettled it. So I think there won't be anything untoward there. If there is, it's a tiny negative on growth. It will subtract something from growth. And if I said a tiny negative on growth, it would be a tiny, tiny negative on inflation.
Alan, just back to the other point you were making too, and I think this is quite important. You know, the markets seem to be overreacting to a hawkish Fed, and less so if the Fed is leaning dovish. And my guess is someone in the market, or there's a camp out there that is starting to smell that, and you know, it might be too early to talk about this, but the next hiking cycle might just be closer than we think. I mean, do you think in 2026 we'll be closer to the last cut or nearer to, you know, the first hike? You know, where do you think the conversation will be, say, in 16 months' time?
The honest answer is I don't know. If you want to ask me my hunch would be a little closer to talking about when is the next rate hike going to start, especially if by 2026 you mean later in the year, not January, but sometime well into 2026. That's a guess, but I don't have to tell you that 15 surprising things could happen between now and then.
Last question, Alan, on the neutral rate, and there's maybe the indication that it could be higher than previously thought. Where do you see that, and what's your interpretation of how the Fed's looking at that question as well?
I think they think the neutral real rate is around 1%, which is a little bit higher than they thought a while ago, than when they seemed to be congealing on 50 basis points. If you add to that where inflation is likely to be rather than where they wish it was, so where they wish it was 2. We seem not quite to be getting to 2. So if it was 2.5, say, that would give you a neutral rate of, in nominal terms, of 3.5, or maybe a pitch higher than that. That's where I would guesstimate it is right about now.
Alan, thank you so much for taking the time. Let's speak again, sir. That was Alan Blinder there, just in case for viewers who didn't know. Former Fed Vice Chair, of course, and currently the Professor of Economics at Princeton University. Just ahead here on shows, we continue to track the central bank decisions today, the fallout we're seeing from the Fed, this sell-off we're seeing in markets. And this time, we're turning our attention to the Bank of Japan, set to give us their rate decision sometime over the next 2 hours or so. Counting down to the open of trade, just over 15 minutes away, the Thursday session in Shanghai, in Shenzhen, and here in Hong Kong. This is The China Show. Good morning.
U.S. Secretary of State Antony Blinken sits down for an interview with Bloomberg's David Gura as he prepares to leave office. Tune in today, only on Bloomberg.
Right, welcome back. All right, as well, somewhat expected, but it did come in slightly stronger than estimates. 1,200 points is the difference between the midpoint of the day and the estimates. We were expecting the PBOC to lean further into, given the weakness we're seeing, not just in the currency, right, across broader Asia EMFX. 1,200 pips is the spread to estimates. And I can tell you now, this is the first time we've seen a 1,200 spread. Interestingly enough, going back to July 31st of the year, that was right the day before the carry trade unwind. So there is some leaning taking place here. Yeah, there we go. First time since July. Let's continue the market conversation across asset as we consider this. We consider the pushback on the PBOC, the sell-off we're seeing across the region, the BOJ decision coming up. Sherry An in Tokyo for us, our Asia trade co-anchor, and Mark Cranfield in Singapore for us out of our MLive team. Sherry, I'll start with you. No change expected today, although they could surprise us. We know that.
The BOJ could always surprise us. But yes, right now the expectation by economists surveyed by Bloomberg is that there will be no change in the rate at that 0.25% level. And one of the reasons being perhaps the political backdrop, making it a little bit difficult for the BOJ and not wanting to risk any blowback. We do have the Prime Minister Ishiba just having passed that budget through Parliament, that stimulus package. And he had to really negotiate with the opposition as well. We've heard from one of the opposition parties talking about not being ready for a rate hike at this point. Of course, we do have the Japanese yen under pressure, which could be a variable if we continue to see more weakness on the Japanese yen. Will the BOJ surprise like they did back in July? But that could also cause more market instability. For today, what we'll be watching out for is signaling, especially what happens in the rate decision in January, especially if we get any dissent from board members. We'll also be watching a broad policy review by the Bank of Japan, which will have no immediate implications for policy, but sort of a nice way to wrap up the year end, the last policy meeting, and perhaps a little bit symbolic in sort of showing investors that they do want to normalize policy in 2025.
Mark, we do need to get your reaction to the daily fixing there. As Dave was saying, it's the first time we've seen it at 1,200 bips, the difference between the estimate and the actual going back to July of this year. But what's your thinking around that?
They're going to continue with this for quite a while. I think the widest we've ever seen is about 1,500 pips, I think, difference between traders' estimates and the fixing. So still a way to go before we reach that. And don't forget, when we were having fixings above 1,000 pips differential, it went on for some time. It's all about keeping the dollar-yuan rate below about 735. That seems to be the pain threshold for the PBOC. So by setting it this way, it means that the daily trading range still has a 733 handle, even though the fixing and the gap is now 1,200 pips. If you look at the dollar-yuan can't trade above 733.49 is the precise number for today. So that means that as soon as the onshore rate gets anywhere close to that, it's not at the moment, it's still quite a way below that. But if it gets close to 733, then the triggers automatically come in. People have to try and defend that level. And so it becomes a self-reinforcing thing where they can cap the weakness in the yuan. So it's all about that, really. They obviously don't want to let that go before they really have to. It may well be, if we get into next year and that they've been hit with a lot of tariffs, and we get something like a 2018 scenario where they need to adjust the yuan to compensate for the new tariffs, then they'll have to reconsider what's the correct level for the yuan. But they don't want to go there in a hurry because they know the market will, if you give the market a chance to push a little bit in that direction, they'll take a lot. So we'll end up with a situation where the yuan is spiraling out of control way before Donald Trump even becomes the president. And the PBOC obviously don't want to be in that situation.
Someone in a bad situation looking at dollar-yen going up is Sherry An, of course, who earns her keep in the Japanese currency. And Sherry, you're not off the hook here. Still, I mean, if you find yourself in Hong Kong, you still owe me and Belle a drink, and you're going to pay for that bill. I'm going to tell you right now. Should the yen
Hong Kong
make
dollars,
a difference,
which is much stronger because of the U.S. dollar, great.
Oh yeah, like, Belle, high five.
Sherry can come to Sherry can come to Singapore to drink
You
to
guys
us.
come here. That's the best scenario at this point. But let me just really point to what Mark just said when it came to the potential tariffs and the uncertainty in the markets, because that's also something that the BOJ will be contending with in January. I mean, the BOJ needs to decide just 4 days after Donald Trump takes the presidency again. If we have more financial market volatility and potential for market ructions like Mark mentioned with the Chinese yuan as well, that could make it very difficult for the BOJ. Expectations are right now that they will move in January. The economic backdrop is pretty good right now. We have seen November core CPI, for example, beating to the upside, coming in at growth of 2.2%. We've had the Tankan quarterly survey also showing that confidence among large manufacturers in Japan remains strong, and indications that the labor market negotiations, Shunto wage negotiations in the spring, may be unfolding quite well. So we will get the next quarterly report out of the BOJ in January as well, which is why economists think that January could be the time when they actually go ahead with that rate hike.
All right, I think maybe everyone will need a drink after today's busy news flow. But anyway, that was our Asia Trade co-anchor Sherry An there in Tokyo, as well as our MLive strategist Mark Cranfield in Singapore. And taking a look at futures, how they're opening ahead of the market starting to trade. Just about 6 minutes from now, we are pointing to losses here, particularly noticeable the Hang Seng guiding for a 1.3% drop at the open. But more ahead, this is Bloomberg.
Right, welcome back. Just under 5 minutes away from the opening bell. We already did get the first warning shot on item number 1 here of a fix that was really stronger than expected. There's a question mark around the rally. We are up, though, for 2 straight days on the mainland benchmark. We're down a little bit right now in your pre-markets on the CSI 300, down 0.7 to 1%. The New World Development, a couple of things there. You did get a sell-off in perps yesterday, perpetual bonds. So obviously credit's under pressure. On top of that, the Fed doesn't look like they're going to cut a lot more next year. So that's going to put the entire almost Hong Kong developer space under pressure today, given, of course, how we simply import rates there. Siganti hearing taking place in Hong Kong. Chip stocks, we're also looking at that going into the open today. So the sell-off we're seeing across the region post-Fed. Hong Kong is set to open over 1% lower, as you can see on your screens. And within the chip space, of course, this is the Micron story, isn't it, Bill?
Yeah, that's right. They gave a weak forecast, still strong in the AI component, but concerns around the demand for memory chips that are used in smartphones, also PCs, and that's playing out today. Welcome back. You're watching The China Show, and we're counting down to the open of markets this morning. I mean, when you've had the worst U.S. market reaction going all the way back to 2001 following a Fed decision, when it's a cut as well, which is also crazy. It wasn't a hike at all, but it was hawkish, I guess, and then a lower chance of easing for next year. 2 cuts now, possibly instead of 3 that have been priced in, and that's certainly, of course, going to have ramifications, even if it's an overreaction.
As Alan Blinder, who joined us 20 minutes ago, said, the former Fed vice chair, he said it was a gross overreaction in markets, but it's really the cards that we've been dealt today going into the open today, where we're called 1.3% lower on the Hang Seng Index, also lower about 1% on A50 futures. The silver lining, though, across assets is a stronger fix out of the PBOC, and maybe push back here as far as the bond rally goes, so maybe some semblance of not so much a straight line there as far as yields go. On the CGB space as well. That being said, slightly lower on yields, 10 and 30-year yields on your screens. Let's have a look at Hong Kong, please, if we can. And if probably this is really, if there is a visual of what pulling your nose hair is like, this is it. Look at that. 1.6%. Ouchie on the Hang Seng Tech Index. 10 cents all the way through to China Construction Bank on the way down. The Hang Seng Property Index, I'm not sure how clearly you see that. That's the first row, second from the right. We're down about 2% on that. I mean, certainly that's a direct hit almost, given a higher floor on rates next year. graphite producers on the back of this, I think reporting yesterday that I think we're going from, if I'm not mistaken, from 0 all the way to maybe triple digits on tariffs. We're seeing some declines, not to the extent expected, but of course this is not a straight line as far as the supply chain is concerned. And just very, very quickly, we're looking at Hong Kong developers. And of course, within that, there's also this idiosyncratic story. Oh, there we go. New World Development off another 4% today. The fourth ticker on your screens is the perpetual bond that actually fell. I think we fell about 4 or 5 cents yesterday. We're now below, as you can see, 40 cents on that specific one. So, yeah, I think we have the story, in fact, right now, Bill.
Yeah, that's right. Let's bring in our China credit reporter, Loretta Chen. And I mean, suffice to say that the market is definitely expressing something, and that is concerns about the debt load and maybe the inability to service those loan obligations as well.
Yeah, so recently New World actually approached some banks in Hong Kong to talk about potential extension for some bilateral loans. So notably, it starts with bilateral loans because these loans are easier to negotiate. You only negotiate with one bank at the time. And, the debt load of these bilateral loans won't be huge. So I guess it makes sense from the company perspective to manage all its maturities coming into next year. You would start with these smaller maturities. That's easy to get extension at the time. And at the same time, we heard, people from our sources telling us that New World is also in talks for waivers on some syndicated loans. So these are, billion-dollar syndicated loans that actually had potential breach of covenant. So that could be a potential issue, and the market is certainly worried about that. If New World couldn't get that waiver, that could be a technical default situation for the company. Well, I think the base case is that we believe the banks will still continue to support the company. As many other Hong Kong developers, New World heavily relies on the bank's credit lines to support its borrowing. So that's a very important factor for us to watch.
Is distress, the word distress, too strong a word to describe the financial situation now?
I think if you look at New World's bond prices, it's certainly in distressed territory. It's deep into distressed territory. And I think part of that has definitely been driven by people's concerns for its ability to service debt. I think another issue is just the broader Hong Kong property market is under pressure. And now that we know next year the rates aren't going to go so low, and people in Hong Kong have actually been expecting that interest rate cut that probably won't come as soon as people expected. So I think we're going to continue to see that broader pressure. So that's the second layer for all of the developers in the city.
Fantastic. Oh, fantastic reporting, not fantastic news. Loretta, thank you so much. Loretta Chen there, our China credit reporter, who actually reminded us that, we forgot to mention the HKMA actually cut their interest rates today, the base rates. Watch HIBOR today on the back of that. Anyone with a mortgage right now must be just punching themselves in the face. The story across the Japanese market continues to still, and have a look at where we are as far as the car makers are concerned. There we go. Day 2, Nissan up about 1% still. We're getting a pullback across most of the others involved in this situation. Let's bring in a transport reporter, Nicholas Takahashi, who's been extremely busy, I would imagine, Nicholas, and thank you for taking the time. I want to ask you about the Foxconn or the Honhai complication here. What does that presence mean for this specific deal, Nicholas?
Apologies. Thanks for having me back. The Foxconn presence definitely complicates things. It's difficult to speculate exactly how all the players in this situation feel about its, kind of shoving its way into this conversation. Honda. It was suggested by a Nikkei report overnight that Honda would cut strategic ties. It's currently got a sort of a research and development partnership with Nissan going, and the report suggested that Honda would cut those ties with Nissan or act as a white knight should Foxconn try to perform a hostile takeover of Nissan. All that is to say, we're expecting merger talks to begin next week, according to local reports. What influence the sort of specter of a Foxconn takeover has over that, I think we'll see in the details as they emerge.
Yeah, and we were just discussing earlier something sort of an interesting anecdote on that interest from Hon Hai is that the man who leads the EV efforts at Foxconn, which really haven't borne much fruit so far, Jun Seki, was actually at Nissan, rising to executive levels over a career that spanned nearly 3 decades there. But so an interesting sort of tie-up or link there. But speaking about Honda specifically and the engagement with Nissan, what would Honda actually take away from any sort of deal?
Well, that's sort of the big question weighing on the industry right now. For Nissan's end, the benefits seem more self-evident. As a lot of folks probably already know, last month when we saw earnings come out, Nissan reported cratering profits, weak sales in North America and China, all of which forced it to cut thousands of jobs, pare back production capacity, and lower its annual fiscal outlook by 70%. On the other hand, Honda has been trying to build scale in North America where hybrids are selling very well, Japanese hybrids in particular, and EVs in China have taken hold. So for Nissan, this could help stem the bleeding, but for Honda, whether this helps them build the scale that they've been seeking for years is a big question hanging over the partnership.
That was our transport reporter, Nicholas Takahashi there. And we actually are going to some live pictures from Seoul now. There's an ongoing briefing by the legal team of President Yoon. And what we're hearing here is that the defense team is essentially saying that Yoon could appear himself in court if needed, but they are still putting together their legal defense as well, that the team representing President Yoon, who has been, of course, impeached over the weekend. So certainly a developing story in Korea, and we do know that the Constitutional Court has as well started reviewing that impeachment vote, again, that happened just a couple of days back.
Yeah, okay, a busy news day. Suffice to say, let's go to the chip story right now. You might have seen the iteration of this with the open this hour in the markets in Taiwan, and yeah, the massive drop we had in Micron overnight. And as you can see, it's on top of the Fed. There is also this element and this pullback we're seeing. TSMC bottom, if your screen's 2.3%. Yeah, 15% in after-hours trades, or even more than that. It's really the guidance here, Belle, that really shook markets. I think it missed projections by quite a bit. I think about $1 billion.
Yeah, $1 billion. I mean, analysts were expecting around $9 billion in, or just under, in sales for the fiscal second quarter. So that ends in just a couple of months from now. They're projecting about $1 billion less. So it's a huge drop. It's interesting, though. You've really got to sort of think about it. AI is still strong for the business. Non-AI components.
Oh, it wasn't AI.
No, AI is very strong, and they're seeing very robust sales around that space. HBM is standing out. But the demand that they see for more of the, again, going back to that legacy, older technology chips that are used in smartphones, PCs, that's still really sluggish. And so the outlook for that type of demand wasn't strong. What is also interesting is that they actually spoke about the pricing because, of course, semiconductors historically have been really boom-bust cycles. But they're saying that actually they've been a little bit more prudent, the three main memory companies, Micron, SK Hynix and Samsung, more disciplined in how they've added new production. So maybe you won't see such extreme moves when it comes to or inventory gluts like we've seen in the past. This is talking about HBM in particular. But that is the moves that we're seeing there, of course, really pronounced off the back of that drop in Micron in late trade.
Yeah, 153 a share is the projection, less certain items. The initial expectation was 192. That's EPS projections. Quite, again, a massive drop there. Just ahead here on shows, Donald Trump rejects this bipartisan government funding bill, increasing the likelihood of a government shutdown later this week. Details next. This is Bloomberg. Right, welcome back. More breaking news from this hour. So President-elect Donald Trump says he opposes this proposed government funding bill threatening the stopgap measure that's, well, effectively would keep the government open until mid-March. We have Bill Ferries right now, our Asia senior editor, with the latest lines. I mean, Bill, yeah, in the last, 40 minutes or so, we now have a new development here. Unexpected, but yeah, noteworthy nonetheless.
Right. This is a meltdown that is still in progress. So I would expect some more updates through the night. President Donald Trump and J.D. Vance coming out against this temporary, what we call a continuing resolution legislation that would fund the government through March. He seems to be upset both at some of the spending that's included in there, which includes about $100 billion in recovery efforts after a pair of hurricanes went through the United States. But he's also really focusing on an increase in the debt ceiling, which would come up some point in the spring or early summer in Trump's presidency. That, he says, is a fight he doesn't want to have at that point. He wants an extension or an increase in the debt ceiling to take place now with Joe Biden still in office, because this is a perpetually difficult fight for Republicans in particular to have. Donald Trump doesn't want that on his plate just a few months into his administration next year.
So Elon Musk has also been inserting himself into this debate or quandary. What exactly is he saying?
So, yeah, if you're Mike Johnson, the Speaker of the House, you just negotiated this deal. You've had to work with the White House at some level. You've had to work with Democrats in Congress. You've had to work with the president-elect who takes office in 35 days or so. And now you're also, according to Mike Johnson, he's been texting Elon Musk and Vivek Ramaswamy. So as additional partners or protagonists in this entire process. Listen, Musk and Ramaswamy are taking over what they're calling this Department of Government Efficiency. They're looking for ways to cut costs. This plan, in their eyes, doesn't do that trick. It's increasing spending quite a bit, even if it's keeping a lot of government agencies just at last year's levels. As I mentioned, there's $100 billion in new spending. There's some other inserts into this legislation. They want to see some cuts coming now, but it's right now the Republicans are really more than anything scrambling to come up with a plan B. We just had Steve Scalise, senior member of the Republicans in the House, saying they don't have a plan B. They acknowledge that their current plan is probably dead, but there's only about 24, 48 hours left before we have at least a partial government shutdown just before the Christmas holidays.
Yeah, it really doesn't seem like there's much time for haggling, but certainly a lot of different parties to satisfy there. That's our Bloomberg Asia senior editor, Bill Ferries, and to some of the major geopolitical stories that we're following this morning as well. And the U.S. Supreme Court says it's going to be hearing TikTok's challenge to a law that would ban the app next month if it isn't sold by its Chinese parent company, ByteDance. The court scheduled arguments for January 10, allotting 2 hours, which is double the usual time. Unless the Supreme Court blocks it, the law will take effect January 19, which is the day, of course, before President-elect Donald Trump is inaugurated. U.S. graphite producers are seeking sharper tariff increases on Chinese imports. They say Beijing's state subsidies are artificially lowering prices and making it impossible for U.S. companies to compete. The industry group hopes to trigger tariffs of up to 920% in response. Since the material is crucial in making batteries for EVs, a tariff increase would end up raising the cost of US-made EVs. China has repeated its pledge to maintain peace in border areas with India as the two countries resume formal discussions on the subject for the first time in 5 years. Chinese Foreign Minister Wang Yi and Indian National Security Advisor Ajit Doval met in Beijing and reached a 6-point consensus. Talks will continue in India next year. The US says corruption investigations ensnaring some of China's top military leaders could hinder modernization goals for the country's armed forces. The Pentagon's annual report to Congress says the new wave of corruption allegations has touched every service in the PLA. It adds that many have shaken Beijing's confidence in high-ranking PLA officials.
Coming up next year on the China Show, Chinese President Xi Jinping is in Macau to mark 25 years of Beijing's rule. We'll bring you the latest out of that trip coming up next. And before we head to the break, we'll leave you with a look at markets. Chinese markets are down, coming off lows of the day, but not as bad as the next board is about to show you. What a sell-off is really taking place across most of the Asia Pacific. Silver lining, U.S. futures are steady following the worst day in months overnight. Plenty more ahead. This is Bloomberg.
Time for a look at top headlines in China's domestic media, and President Xi Jinping's trip to Macau is dominating coverage today. He's on a 3-day visit to celebrate the 25th anniversary of the city's return to Chinese rule. For more, let's bring in our China correspondent, Min Lo. And yeah, I mean, how's it going so far with with Xi over in Macau? We know you're heading there tomorrow as well, so.
Yeah. So President Xi and his wife arrived yesterday to great fanfare. There was a crowd cheering. There was lion and dragon dance. And one of his first public remarks after arriving was to laud what he calls the universally accepted success of the one country, two systems model with Macau characteristics. This is his third trip to Macau as president. The last time he was there was in 2019 when the neighboring city of Hong Kong, where we are now, was going through the throes of those anti-Beijing protests. And we know Beijing has time and again been very full of praise of Macau as this bastion of harmony, stability and loyalty. So he's there to meet with the outgoing chief executive. He acknowledged the work of the outgoing chief executive for maintaining national sovereignty and for leading the city out of the COVID-19 pandemic. He's going to attend a gala dinner tonight, and tomorrow he will attend the inauguration ceremony of the new chief executive.
Well, tell us about the new chief executive then.
Yeah, so it is Sam Ho Fai. He is someone of many firsts. He is the first to not be born in Macau. He's born in southern Guangdong province of China. He's also the first chief executive who does not hail from a business background. So he's a former judge, someone who won an uncontested election pretty much endorsed by Beijing because he got overwhelming support from this 400-strong election committee that is made up mostly of Beijing loyalists. So analysts are saying that his appointment would likely mean that Beijing's policy agenda will take greater priority, perhaps meaning the declining influence of the business circle. So he is taking over the previous chief executive's agenda, which is in some ways also Beijing's agenda to diversify Macau's economy away from just gambling and casinos, which now contribute to 80% of the region's revenue. So the blueprint for the city is to really become this international hub for tourism, commerce, technology, and to be an international MICE venue as well.
Okay, Min Lo on Macau. She said it there, of course, for work, I would imagine. Yeah, so stay away from the tables.
Get some egg tarts back.
There we go. Diversify that economy away from gaming. Min Lo, our China correspondent there. For a look at markets right now, so we're looking at agriculture stocks in particular. So a couple of things here. Xinhua News reported that China is looking to ensure that stable supply and stable prices of agri-products. I think on the back of that, too, we're looking at deeper reforms in the sector to effectively ensure that things do remain, I think, at that point, fairly stable. It actually came through during the annual Central Rural Work Conference that was held over in Beijing. So a couple of stocks to watch, everything from machinery suppliers to actually producers of things like seeds, for example, as you can see there on your screens there. Yeah.
Well, that's one corner of the market that we're watching, but I think
back to the Fed.
Many other corners of the market are being dominated by the Fed story today, and we've seen that big move in FX in particular because we of course had the moves in Treasury yields moving higher, but also the dollar strength, and that was a real story in the market activity overnight because we saw the gauge holding around a 2-year high, and so this morning in the session today again you're continuing to see the moves in Asian currencies against that. Japanese yen of course standing out because we've got that BOJ decision maybe in the next hour or so. I mean, the expectation, we get a hold today, but this is a bank that isn't afraid to surprise either.
No, they're not. And I think when you look at the survey that we've done across the economist community, I think we have about 50 odd or so economists that we've asked. Just over a fifth actually think that that move could actually come today. So minority, but certainly not broadly consensus. A couple of other central bank decisions today. You have the Bank of England, of course, coming through, and within the Asia Pacific also we do have the Philippine Central Bank, which is expected to deliver, I think, a third rate cut given the inflation situation there, which is, of course, easing somewhat quicker than what we're seeing elsewhere in the world. And I think on the inflation story, we did get one, of course, out of, I believe, the UK. I think it was yesterday to underscore the point on the Bank of England story. Okay, the equity markets in these Chinese markets this Thursday are doing this 23 minutes into the session here. So you know what? We are coming off very quickly lows of the day. So now we're considered as flat in the CSI 300. Hang Seng Index is now 0.7 to 1%. Just some context, the HS Tech Index, top row, leftmost side, which was down as much as 1.7%, is now just under 1%. And the yield story, of course, continues to be one that we're tracking given the potential pushback, or if not already, from officials here on the bond rally in China.
Yeah, the PBOC is sort of signaling for the first time in months that maybe they're not so happy about the level of that rally and the excitement around CJBs that we've seen, or China government bonds that we've seen in the market. Hang Seng Tech to note as well, just because when I take a look at the broader gauge, how we're trading today, every single sector is in the red, and IT is actually really the noticeable drop today. So that's also possibly, I mean, Micron, probably not the best day for them to have reported earnings in after hours because the news was already bad. But when you combine the bad news plus around the outlook for legacy technology, but you combine that with the Fed decision and the market reaction, I mean, it's not great there. But coming up in the next hour, we're going to be counting down to the impending decision from the BOJ. We're going to get analysis from BlackRock and also from a former BOJ board member. So stay tuned for that. Lots more to come in the next hour, including possibly that decision. You're watching The China Show. Welcome back to The China Show. Taking a look at the CSI 300 half an hour into the session this morning. And you know what? We're getting really close to at least being neutral in the session today. MSCI China's under pressure, but still that's not too bad when you consider the market moves overnight. Wall Street, worst market reaction to a Fed day going all the way back to 2001.
Wow. I don't think I was born in 2001.
No, it's a few years before you were born, Dave,
how
for
can
sure.
you get away with that, David? I mean, to Belle's point, right, we are doing slightly better, in fact, a lot better. I changed that on CSI 300 compared to the train wreck we're seeing across the region. I mean, to the point on the dollar, right, we were looking at the dollar, maybe some signs of exhaustion there going into this Fed meeting, and then the Fed told us they're going to, well, as far as the dots go, just 2 next year. And the point that Alan Blinder, who joined us this time in the last hour, mentioned, former Fed Vice Chair, said there's actually downside risk to that number of 2 cuts next year because everything so far that you look ahead into next year is inflationary. Now, whether those conditions, of course, come to fruition is another thing altogether. The FX markets are looking like this. Dollar China, of course, the reason perhaps we're seeing a little bit more movement in dollar China today is because of the fix, which really anchored. There we go. Thank you so much. 1,200 pips stronger than estimates. The equity markets, though, as we, I think, far from alluded to earlier on, the train wreck we're seeing, we've cut through the moving average, the 200 moving average today on the Asia-Pacific benchmark. So 1.4%, almost every single market is down, every single sector is down, I can tell you that. As we speak, the 2- and 10-year yield in the U.S. right now, slightly lower following the massive melt-up that we had overnight. So a couple of more central bank decisions today on top of the BOJ, which we'll get to in a moment. The Bank of England, you have the Banco Central in the Philippines. And, of course, in case you missed it, and you probably did because of all the news flow that which came through, there's a Micron story, and there's also New Zealand entering a recession, I think, after GDP print their missing estimate there. But why do we talk about Japan and the BOJ?
Seems like a good moment for it.
Why not?
Yeah.
Go for it.
That decision could come actually within the hour, maybe. Depends, I guess, on how decisive or indecisive BOJ officials are feeling, given that does have a bearing on the time it comes out. But our Asia Trade co-anchor, Sherry Ahn, is joining us from Tokyo. And Sherry, that's sort of the... Are they going to hold today? Are they going to hike? And what are they going to signal then if we do see the hold today about January?
Yeah, right now, economists surveyed by Bloomberg, a narrow majority thinking that it's a hold at that 0.25%. Also, swap markets the entire week, really pricing in less than 20% chance of a rate hike today. And a lot of the signaling has already come from policymakers. We had reported earlier on Bloomberg that policymakers did not feel the need to wait, to really hurry up with these rate hikes, that they saw little cost in waiting. And we have, of course, a very busy political schedule as well. We had the stimulus package being passed by Prime Minister Ishiba and the wrangling and political infighting that went along with that, what this really means for the opposition party, a key party that Prime Minister Ishiba needs to work with, now signaling that they don't want to see a hike in this environment. So what will we be then watching out for in today's decision is, okay, the signaling, will it come then in January? We'll also be watching a broad policy review, sort of a symbolic way to end in the last meeting of the year, a symbolic moving, perhaps really looking forward to the normalization path in 2025. Little implication, though, when it comes to actual policy.
So, Sherry, if they don't move today, suffice to say, would January be consensus then? And how would the yen affect how they approach this meeting today?
The Japanese yen is a key variable here, right? Because we're trading at around that 154, 155 level. And last time when the yen weakened past that 160 level, we actually saw the BOJ moving in July. We had a lot of pressure coming from politicians as well, given that households were suffering because of a cheaper yen and higher import prices. We have seen the economic backdrop also become pretty solid. We had seen core CPI for the month of November surprising to the upside, not to mention that services inflation, which is a key metric that the BOJ watches, has also improved. On the other hand, we would also get this BOJ policy decision in January, just 4 days after President Trump is inaugurated again. What does that mean if we have really that financial market volatility that the BOJ does not like to see? Other people also saying that perhaps other metrics within the Japanese economy are not as strong as people think, especially when we saw the third quarter GDP numbers being revised upwards. We actually saw a key component of consumption actually being downgraded. So there are still a little bit of mixed reviews on the performance of the Japanese economy and whether this the fundamentals can actually bear another rate hike. But right now, economists thinking that if tightening continues and another rate hike comes, that could happen in January.
That's our Asia Trade co-anchor there, Sherry Ahn, and we're actually going to have more analysis on the BOJ policy path just ahead. We'll be speaking with a former BOJ board member, Sayuri Shirai, and then in the next hour, of course, hearing from the Monex Group expert director, Jesper Kohl. But the big news we have right now is actually breaking in terms of the IPO outlook for Hong Kong, because we've just had some lines crossing that CATL, this is, of course, a major player in the EV battery space, is looking to pursue a second listing in Hong Kong. This could come in 2025, so next year, of course. They are said to be in talks with advisors on this listing. The amount that they're looking to raise is at least $5 billion. That makes it the biggest listing, or could be the biggest listing, going back to 2021. Medea has been the biggest one we've seen so far this year. That was at 4.6. So eclipsing that, that could really be a trend. We start to see more and more of these homecoming listings, really, or listings in Hong Kong, given you've also got those geopolitical tensions away, and we know that's sort of a focus perhaps of the exchange here.
Yeah, I think it was Julia Fioretti, of course, our colleague who oversees, of course, our deal coverage here, part of that team, did mention that if there is some, some predictability that we can attach to the listings next year, and who knows what market conditions are like, it's really this trend, to Belle's point, of this A&H share and a lot of the mainland companies that already have listings onshore coming here to Hong Kong. HKX on your screen is down about 1.2%. CATL, there we go. At least $5 billion could come as soon as next year. Okay, we will table that for now. Let's take the story back to the macro picture and these markets, which are selling off in the Asia Pacific. We're steadying, though, on S&P futures. Thomas Taw is with us here, head of APAC investment strategy at BlackRock. Nice to see you, sir. Do I buy this dip? Let's start with U.S. equities.
I was hoping for a relatively relaxed Christmas period, and obviously that's not going to happen. I don't think quite yet.
Okay.
I guess the question is, does this shift from the Fed dot plot really change how we feel about markets next year? Not really, because we're basically saying rates are going to be higher for longer anyway. So I think it's going to take a little bit of time for the rest of the market to actually digest that. But it creates a lot of uncertainty, particularly when you look into 2026. I mean, the range of where the Fed neutral rate is going to be is somewhere between 2.5 to 4%. So it's a pretty big range. So investors need to be agile, bob and weave, as we always say.
Yeah, coming from a pro boxer, former pro boxer. Are you still are? Oh, no, anyway, that's a different conversation.
Another time, Dave.
Okay.
But if you're working around that base case that rates stay high for longer, what is your sort of trading map then looking like, or your plan?
Well, I mean, from a global perspective, the big question is, I think, well, two big questions. One is, are we still going to see U.S. exceptionalism next year? I think the answer to that is yes, but we are seeing a broadening out in terms of what clients and investors are looking at to be the drivers of the U.S. equity market. So you see forward estimates for earnings growth next year in the S&P 500, which is mostly driven by mega cap 7, tech, et cetera. Basically the same as the equal weighted index. So you're seeing this rotation. And that's mostly taking place in financials as the yield curve steepens, which I think makes a lot of sense, particularly with Trump deregulation coming, but also in the small caps, which I think probably doesn't make as much sense because as rates move higher, the funding cost for those smaller companies goes up, and that makes it more difficult. So I think that the financials rotation is real. I'm not really sure about the small cap rotation at the moment.
Is that the same, almost a saying from a strategy perspective? It's value over growth, or am I overthinking that?
I don't think on the factor level we're really seeing those shifts. I think people are still looking at growth as kind of the big theme, mega trends into next year and beyond. But there's always room in the portfolio to have these tactical rotations, and I think it's happening more on a sector level than an actual factor level. And when you think about factors as well, it kind of depends if the market is going to be trending like it was this year, or whether we'll see kind of more of a trading range, which I think it's going to be the latter for next year. So certain factors will work better in that environment, not so much momentum, growth, tech, et cetera.
Speaking of tech, we have still seen, though, that in earnings calls, we've been speaking with different analysts, the AI theme is still intact, it seems, for next year. So is that still something that you're interested in, even if you've got, prices that have risen?
Yeah, I think definitely over the long term, but I think in the short term, you are going to see a little bit of the froth being taken out of the market because very simplistically, it's been a very good year, right? And, moving into Christmas, now we have this event where, the Fed are a little bit more hawkish than maybe some anticipated. You take a little bit of profit and you reset for next year. So I think it's still definitely a trend. Next year will be very key in terms of whether that earnings growth actually comes through into those AI companies, because it has been a lot of rhetoric. We're all kind of using AI, ChatGPT, whatever it might be, but we actually need to see what the net productivity gains from AI usage is going to be. And I think that will start to come more into the fore next year.
What are you seeing in terms of fixed income flows?
Fixed income flows this year, it's been interestingly quite a lot of inflows into long duration. And when you look at it from a market's perspective, that doesn't actually make that much sense.
Yeah, I was about to say that's counterintuitive.
Yeah, but if you think about 2023, it was all about short duration, right? We saw trillions of dollars going into money market mutual funds. And I think basically what's happened this year is investors have said, I think the middle of the curve is the right place to be. I'm already owning a lot of short duration. Let me add some long duration and kind of average it in. But I think 3 to 7 years is still the place to be. And I think the fixed income allocation is relatively easier than the equity allocation because you're getting income. The Fed's rates are going to be higher than expected, so there will be a lot of income in the market. So it's not actually that difficult to sort of get that 5 to 7% yield target.
Yeah, well, I think on that too. I think back in 2023, there was still the conversation around, do I stay in cash or even go into, say, the 2 to 5 year sort of part of the curve?
Yeah.
Is that conversation still a relevant one to have? I mean, do you expect more people to come out of cash, or is cash still going to be still a sizable area of pushback for people right now?
Yeah, I mean, we haven't seen that much stepping out of cash this year, but it generally takes about 6 months after the Fed cuts rates for people to start to move. And then you get a little bit more clarity and color on what the future Fed path rate is going to be. And this stepping out of cash, it's not a step out into risk assets. So I don't see it really as a big tailwind for S&P 500 or tech or growth.
Right.
But I think it could be a tailwind for one step up in the risk curve into things like 3 to 7 year investment grade, these type of exposures.
That's the U.S. Treasury flow. But what about for other debt?
There hasn't been a lot of interest in emerging market debt. I think that's mostly a FX concern, U.S. dollar strength, et cetera. The big trends really have been longer duration and then outside of that investment grade exposures. And then we are seeing a lot of interest in things like Asia high yield.
All right, Thomas, you're going to stay with us. That's Thomas Tor from BlackRock, who will be here in the next block. We're going to be, of course, following more on the Fed story, also the BOJ story. You can check all of that out, all the trading activity as well on our Markets Live blog. You can get that at MLive Go. You can also get a market rundown in one click. There's commentary, there's analysis from Bloomberg's expert editors, so you can find out what is affecting your investments right now. We're going to have plenty more ahead. This is Bloomberg.
Friday, San Francisco Fed President Mary Daly sits down with Bloomberg Surveillance for an interview on the latest Fed rate decision. Tune in Friday at 7:30 Eastern, only on Bloomberg.
All right, we're going to get more on our breaking news that we just had at the top of the hour. So this is CATL. It's the world's top EV battery maker. Could be considering a second listing in Hong Kong, looking to raise perhaps $5 billion. This is a Bloomberg scoop. We are seeing CATL shares a little bit under pressure, though, in the mainland listings. Let's get more with our reporter, Manuel Baigorri, who leads our team as well, joining us. So Manuel, what's sort of the rationale for this? Because we already have the listing in China. What's the rationale then for the second listing in Hong Kong?
It's a good point, Annabelle. I mean, we're seeing this theme increasingly in Hong Kong. I mean, the main reason is these companies want access to more liquidity pools. I mean, listing offshore here in Hong Kong, it's a good gateway for them to do so, still provided that listings in mainland China, are struggling. For them, it's becoming an increasing thing that we are seeing. We saw it with Media, and there is a bunch of other companies of decent size that are also looking at it. They need to list at least 5% of the actual market cap in the mainland. So that's why some of these are actually quite sizable in terms of magnitude. But they are not quite technically what we would call an IPO. It's just kind of like basically, having another source of capital that they can use for financing and for potential acquisitions or just accessing new investors, so to speak. So we are seeing more and more of these mainland listed entities coming to Hong Kong as a way to diversify their sources of capital.
It's rare that we see something along the lines of about $5 billion US. Put that into context for us. How large is that compared to what we've seen so far in Hong Kong?
It is big, right? Particularly, David, where we've gone through a really big drought in terms of listings in Hong Kong for very long, right? I mean, you remember 2018, 19, 20, even 21. There was this rush of IPOs in the city, and then it was brought to a halt very suddenly, and for like a couple of years there was pretty much none of that. Now, I mean, this is kind of like a small step in the direction of at least seeing some companies selling shares. Obviously, it's not kind of like proper IPOs of new companies coming to the market, but at least it keeps us all busy, and it's a good boon for the city as well, because at least it's definitely a good sign of action, which we hadn't seen in a while.
Fantastic reporting there out of Manuel, of course, and his team. On the CATL story. By the way, another headline that's just dropping right now is, this is on Ant. You might know more about the story, of course. Just mention here that the company is saying that it has no plans to list. Yeah, well, we know Ant was supposed to be listing a couple of years back, and then obviously didn't I mean, we know the reasons for that one, but essentially it's that question of when they would look to list again, but certainly their fortunes for that business do appear to have changed, and it's looking much more healthy. Yeah. Is it looking healthy enough? And let's couple that, say, and we're talking about Chinese markets here, with the prospect of stimulus and an economy that, frankly, if you think about it, if you had to put a bet whether the Chinese economy responds next year or craters, you probably put it on the former bet, because how bad can things get, if you put it that way. Thomas Taw is with us right now, still head of APAC investment strategy at BlackRock. I think we pose this question to you every single time you're here, but let's see if you've changed your mind. How do you look at China going into next year?
Well, let me kind of pull it back one level. I mean, the way that I look at Asia basically is China is the short-term trade, Japan is the medium-term trade, and India is the long-term trade. So on China specifically, I mean, I don't see a lot of shift from foreign investors in the way that they are allocating over the long term. But I do see the potential for China outperforming next year on a tactical basis, because I do think the PBOC will continue to try and stimulate the market, particularly as we start to get more news out of the U.S. on increase in tariffs. So I think it will be a short-term tactical trade, liquidity-driven, and I think unlike a lot of the past equity rallies or big volatile moves in China, will be more driven by the A share market versus the H share market.
So trading it tactically, I mean, are you still looking at sectors that the government is supporting and thinking about sort of these new economy drivers?
I'm not even going that far down. I'm basically saying if you're looking at MSCI China, you have H shares, A shares.
Yeah.
If you're looking at Hang Seng Tech, it's H shares, and if you're looking at the FTSE A50, it's the A shares. And I think what's in the FTSE A50 and some of these domestic indexes, CSI 300, is much more heavy towards financials, utilities, and basically companies and sectors which are more driven by domestic growth and domestic consumption in China. So I don't think you even really need to go down to the sector level at this point. I think it's more just A share versus H share, and the preference is A.
Yeah, and I'm curious how that's changed, if it has changed at all. I mean, going into the policy pivot back in September, you could take a survey of foreign investors, and they would only go, that group would only go as deep as your 15 biggest tech stocks in China, maybe a couple of more from others. And I'm wondering whether that pool has changed in terms of this being a tactical opportunity. Have they broadened out the investable universe in China?
On an index level, yes. I mean, I think on the single company level, it's more about accessibility. So, those ADR names that you mentioned are much more accessible to U.S. investors, for example. And that's usually the reason why you see more outsized returns in H shares during these rallies, is because you basically have a short squeeze. And I don't think it's necessary that foreign investors have even gone overweight or even gotten back to a neutral level yet. It's just the fact that this news came at the end of September. It was a big surprise. The People's Bank of China and the state have indicated this will probably continue. And so investors have kind of rushed back to get China exposure without really paying that much attention to what's in the underlying indexes. It's more just index China beta.
Well, we both want to ask about the same thing, I think.
Oh dear. Please, by all means, please, go ahead.
Oh boy.
Look, it's actually not that exciting.
Looks like you're getting nervous.
No, we want to ask about Japan and India, but
Sure.
I mean, that was sort of the main investment theme for this year. So is there anything that sort of changes the investment case around it for next year?
I think on India, it's more just the valuations. There's a lot of concern about how high valuations are in India. But again, if you think about it very simplistically, India is being seen as the structural growth driver of Asia, and so I think foreign investors will continue to buy on dips. I think there's still some froth to come out of the market there in the short term. We're kind of seeing that at the moment. But I think that's still the growth driver of Asia. Japan, when I say medium term, talking more about 3 to 5 year. And the rationale behind that is because there's a lot to like there in terms of the structural reforms, dividend buybacks. We've discussed this a lot. Wage growth increases, inflation, a lot of money on the sidelines that needs to be invested. But over the longer term, it's still an aging population. We're not really going to get back to 4 or 5% GDP growth. So I think that sort of 3 to 5 year range is probably the right timeline for Japan.
Thomas Ta, thank you for today, and again, thank you for all the conversations we've had this year. Happy New Year to you. Happy holidays. Head of APAC Investment Strategy at BlackRock. All right, just under 7 minutes to the lunch break over in Tokyo, and possibly a BOJ decision, which could come, frankly, any time now. Plenty more ahead, and preview of that coming through. This is The China Show.
Quick check on what's really, I mean, look, every single sector is in the red today for Asian equities, but there's one that is the most notable laggard, and that is what we're seeing in the IT space. And as we were saying earlier, really for Micron, it wasn't a great day for their earnings to come out because they not only sort of forecast a weak outlook and had a huge drop in after hours to around 16%, it's that concern around demand for chips that are used in things like PCs and smartphones, and that is playing out across these related peers today.
The other, I think, well, many pain points today. The other thing that stands out today is within property and New World Development, following reports that the company is asking its banks to extend its loans effectively. We'll talk about Ivanka's story a bit later on. This is a bit more complicated, but yes. Anyway, we'll take a break. We'll see you on the other side of it.
It's 11:29 a.m. in Tokyo. Japanese markets just about to go on their lunch break. That's for equity traders. Taking a live look at the BOJ. We're awaiting that decision, and yeah, we're basically in the window for it to come out. And if there is sort of unanimity. Anyway, if they're unanimous, BOJ officials, then it could come out earlier rather than later.
Yeah. 5 syllables there, Bill.
I knew you were counting the syllables.
Yeah. Anytime we whip something out like that, it's really for our viewers. The sun is, as you can see, shining on our shot right now, the BOJ building, where, as Bell was pointing out, we are entering that window where we could get something as well. Markets on your right, we're coming off lows a little bit there on the Nikkei 225. So we've actually had a look at so far this year, we've had 7 meetings out of the BOJ. 2 of the 7 have seen a rate hike. That's a 10 and a 25. 10 in March, 25 in July. The middle column shows you the time that the first headline dropped from the statement on the Bloomberg terminal. And it actually took longer for the news to come out, or for the statement to come out, when they delivered the change. And anecdotally, this might have to do with it took more time to translate the Japanese statement into English because of additional changes to what would otherwise be a more sort of plain vanilla statement. And I guess more justification of why they did what they did. But yeah, so on average, it took 40 minutes longer than usual. So suffice to say, in an hour's time, if they haven't come out with their decision just yet, speculation will run high that they're about to maybe announce something new, Bell.
And that's it. It's the speculation. Are we going to see the hike today? Are we going to get a hold? If they do hold, what do they say about what's ahead? And we know that there's a couple of people sitting in Tokyo right now that definitely know perhaps some of the answers to this. Let's get back to our Asia Trade co-anchor, Sherry An, with us there, and also with a guest, Sherry.
Yeah, Bill, I mean, you guys are talking about will they not? And I gotta say, it really confuses me too. And I get slightly worried when the consensus is always hold and no move, because there are people out there, economists, that think that the Bank of Japan should actually move now. And I'm with Sayuri Shirai. She's one of them, professor of economics at Keio University. She previously served as the board member at the BOJ. Sayuri, always good to have you on BOJ Day, because you give us context about this decision, right? Yes. We're now expecting a hold, but you think that the BOJ should actually move now. Why?
Yes. So since October, yen started to depreciate again, right? And then, it's very, very risky to have this kind of yen's depreciation. And it's before Mr. Trump become president. I think it's better to show BOJ's stance that this kind of imported inflation coming from a yen's depreciation is not appropriate. That's actually what they are implying. And then why don't they take action now, and rather than postponing? And then once Trump become president, things become more complicated and uncertain. Why they don't take action now?
Yeah, the January meeting actually comes only 4 days after the inauguration of President Trump, right? So in terms of the yen and its weakness being risky for the markets, explain to us why that is, especially on the cost-push inflation side of things.
Yes. So because the U.S. economy is much stronger than people thought, right? And also yesterday's FOMC meeting, they are going to reduce the number of interest rate cuts. And there is a risk that the Fed may have to maintain the interest rate rather than cutting, because the U.S. underlying inflation is quite strong. right? And then when economy is like that, there's always danger that the dollar becomes strengthened and yen become more depreciated. So and then it becomes a bit much harder to control, yen's depreciation. So I think this is a good opportunity for the Japan to show such kind of cost push inflation is not what they really want.
And because if we get a weaker yen, that cost push inflation could worsen. November core CPI already beating to the upside, 2.2% growth. Mm-hmm. How painful is that for the Japanese economy?
Yes, so consumption is very weak. There was a slight increase in the July-September real GDP consumption data, but still below pre-COVID-19 pandemic level. If we just talk to everybody think prices are getting higher and wages are not catching up, so people are suffering. So, this inflation is mainly coming from yen's depreciation. So that's why government is keep paying subsidy, various tax cuts, and etc. But the whole reason is people are worse off. Right? Mm-hmm. And rather than giving such kind of subsidy, I think they can start to focus on this super cheap Japanese yen. That is the main problem.
Remember the MO from the BOJ of Haruhiko Kuroda's days when we would get all of these surprises that the markets were not expecting? Mm-hmm. We got such a surprise back in July with that rate hike, right? But it wasn't really well received by the markets.
Yeah, so at that time I thought the Bank of Japan is going to raise interest rate, but the market didn't think that way. So that's why it created, people thought that this is a hawkish stance, so it created a big impact. However, because of that, because of the surprise, yen appreciated from above 150 to a little above 140, right? But still super cheap yen. But finally, it corrected. But at the expense, stock prices went down, so everybody criticized. But here I just want to clarify. BOJ should clarify what is their priority. Is it super cheap yen? Or is it stock price? But stock price is up to company, right? I mean, it can be recovered. But what is most important is persistent, excessively cheap Japanese yen, right? So that is hurting Japanese consumers. Then I think priority should be unwanted inflation correction, right?
Which is why communication is very important to sort of give signals to the markets of what the next move is. How's that been so far?
So BOJ is not very successful in terms of communicating. So at the end of July, when they raise interest rate, they are quite hawkish, and they say they are not going to hesitate raising interest rate if their outlook is same. And still now his outlook is same. But then yen appreciated, people criticize. So September meeting, BOJ said, okay, maybe there is some time before our next decision. And then because the yen depreciated again, so in October meeting, the BOJ said, okay, we can remove this, we have still time. So it's very, very, how do you call it, changeable?
Yeah, back and forth, fickle.
Yeah, I think as a central banker, they have to clear what is priority.
What are we expecting from the broad policy review today, though? Does it have any immediate implications?
Probably they will say they want to look at the data very closely, and they want to look at what Mr. Trump's policy will be, like tariff rate, etc. So, and there was spring wage negotiation. But to be honest, is it so important to wait until spring wage negotiation? I mean, better to show the stance. Current exchange rate is not appropriate.
But talking about the wage negotiations in the spring, the junta negotiations seem to give some clear indications that that might go well, that we might see some more wage hikes coming in 2025 as well.
Yes.
Wouldn't that be positive? Doesn't that help the demand pull inflation that we want to see?
Okay. The problem is that this wage hike mainly comes from labor shortage. The physically people are not there. It's not because the economy is growing. So a lot of companies still feel they cannot fully pass on increased imported prices on their sales prices. So therefore, they have to pay higher wages. It means their profit will be downward pressure. That is a feeling many people feel. So wages picking up, but it has to accompany corporate sector's profit, right?
Do you think some of the changes in the political side could actually leave and alleviate some of those problems? For example, one thing that's being discussed right now that the opposition wants to see is raising the tax-free allowance, for example, which would mean what they say is could lead to more part-time workers working longer hours, that could help the labor market.
Yes.
A lot of infighting there. What are the repercussions and implications for the BOJ?
Yeah, so that idea, giving some, more flexible, allowances, so people can work longer. But that idea, to be honest, I think it's not very good because still people limit the housewife, part-time workers. They try to limit their working hours up to the point that they have to start to pay taxes. So they are limiting their working hours. I don't know this kind of tax system is really suitable for Japanese economy with a serious labor shortage. Everybody should work, right, up to their full potential. But right now, because of this tax, reduction system, so people work less. So just, giving upper ceiling, extending upper ceiling, I mean, people work more longer hours, but not to the full extent. So I think rather than focusing on such kind of system, but the whole reason why government is doing is everybody is not happy with the price hike. People feel their purchasing power is dropping. People feel that they are worse off. Then better to start to pay attention to the yen's depreciation.
So what do you think, Sayuri, will be the rate path that the BOJ takes in 2025? And what do you think it should be?
Okay, it's not so easy for the Bank of Japan to raise interest rates. So right now, 0.25%, probably up to 1% is maximum to me because neutral rate is very low in Japan. So probably up to 1%. But my concern is that if the Mr. Trump starts to pay attention to super cheap Japanese yen, and then dollar is so strong, and then he wants the dollar's weakness, and if he starts to put pressure on the Japanese Bank of Japan, that is a bit risky.
Yeah, I mean, we have heard from Donald Trump speaking to Bloomberg, and one of the key concerns around currencies was the Japanese yen weakness.
Yes.
So we'll be watching what he says around that. Sayuri Shirai, always good to have you with us on BOJ Day. Keio University professor and former BOJ board member. Dave, what's the time right now? I mean, it always depends when the BOJ comes out with that decision, as you guys established, right?
It is, well, I mean, you would know. I'm about to quote Japan time, and you're talking to me. 11:40 Japan time. Which means we're still within the window of your holds. In about 40 minutes from now, we'll start to ask questions about what we're doing with our lives, really, more generally. Sherry, fantastic there. Sherry will be standing by for us in our Tokyo studio as we await, potentially, a nothing burger out of the BOJ, but we'll only know when they tell us, won't we? For more on this, though, turn to your Bloomberg, and we have an entire blog going on this. Apart from the commentary on our MLive blog, which talks about more of the market action, the TLive blog gives you a lot more context, and some of the entries have already in place, and I think this is quite important given this is a very complicated meeting coming up. It could happen today. You look at yen positioning going into this meeting today, and we're looking at traders remaining net bearish on the Japanese currency, quite a sizable 30,000 net bearish position here as far as contracts go, as far as hedge funds go, across the Japanese currency space. That's according to the CFTC data, by the way, in case you're curious. Plenty more ahead. This is Bloomberg.
They could have been more hawkish than they were, particularly about next year, given how much their forecast was revised up. And I think their forecast is, as good as anybody else's, certainly as good as mine. They raised their inflation forecast a lot. Inflation is stubborn.
Fed delivered sort of this hawkish cut that we were expecting. I would say the market was expecting. But I think to your point around the dot plot, I think there were a couple of things that the market really reacted to, and what we've seen such quite a big move here.
They should have read it slightly hawkish, but I would emphasize the slightly. This was not a big change in the Fed's stance or their attitudes about inflation. It was a reflection of two underlying realities and maybe a third. The two that are clear is that the economy, the U.S. economy, has been growing more strongly lately than most people would have thought 6 and 9 months ago. Certainly that the Fed thought 6 or 9 months ago. And so growth is higher. Secondly, the steady down of the inflation rate seems to have stopped in the last few months.
There we go. That was Alan Blinder and others who have joined us to almost post-mortem here across the Fed. And I think to Alan Blinder's point there's maybe gross overreaction across these markets and why these currencies are trading where they are. A couple of other central bank decisions today, apart from the BOJ and the Bank of England. You had two in Southeast Asia yesterday. So you had both holding rates for different reasons. There was one, I guess, in the Bank of Thailand conversation is really more, I guess, in many ways showing independence. There is, of course, an economic justification to sit in rates. As far as Indonesia goes, that's really more a currency conversation, and certainly us trading at 16.3, 16.2 on the rupiah, and we took out the 16,000 level, of course, last week, is a key consideration there for Bank Indonesia. As far as the Philippines go, there's obviously the weak currency, but it's really more an falling inflation story. And we are expecting the Bangko Sentral to announce a rate cut later today. That's according to most economists that we've surveyed. For more context on this, Manny Serapi is joining us right now out of Manila, our bureau chief there. Yeah, Manny, take us through the approach here to that meeting today.
So, hi, David. So we're expecting the Philippine Central Bank to cut rates for a third time today. That would follow the 50 basis point cut, 25 each in August and October. So basically, this is largely because inflation has been under control. It fell to 4-month low in the past in September, and it crept back up in the preceding months and in the succeeding months, but it's still within the central bank's target range of 2 to 4%. But I think what we'd be looking out for is what will be the central bank's guidance towards next year, and maybe also take into consideration the weakening peso, which still matched the record low of 59 today and yesterday, and also maybe also factor in the Fed's forecast or guidance of at least 2 reductions in 2025, because prior to that, the Philippine Central Bank governor was looking at 100 basis points for all of 2025. But we'll see what he'll say at the meeting today.
Yeah, it's complicated to your point, Manny, and I want to get your thoughts on what economists are saying and how it really feels on the ground, because you just mentioned they've cut twice in a row. They'll probably do it a third time. But you look at where the policy rate is, it's still sufficiently restrictive, if I'm not mistaken. So give us a sense of how quickly they can continue to lower interest rates going into 2025, or do we expect a slowing of that easing pace?
The last comments from the central bank was after the inflation data was out, which crept up to 2.5 from 2.3 in the previous month. And they said then that they will take a measured approach in its easing cycle. And I think they will do just that, because expectations are that inflation might continue higher next year, because consumer demand is firming up. And we're also expecting upward pressure from things as power rates and wages. So I think they will be more careful in going to 2025. And I'm not sure if they will still go ahead with what they said earlier, 100 basis points to bring the level to around 5% next year. I think they'll be very careful with their easing cycle.
That was our Bloomberg Manila bureau chief there, Manolo Serapio. And I think when it comes to that outlook for easing, certainly the pressure has been put on the RBNZ this morning, Dave, because we had the GDP figures coming out, and actually we saw a steeper than expected recession. So we had the GDP declining 1% in the 3 months through September. Economists actually had been looking at a 0.25% contraction. The Kiwi dollar off the back has fallen to a 2-year low. And again, investors are stepping up their bets around easing. And actually now Westpac sees the RBNZ cutting the cash rate to 3.25% through May of next year. So Our Bloomberg intelligence team is saying, or economics team is saying, look, it's partly a mirage because you've got sort of those higher base that's coming into this, and they're saying that broadly the economy is in line with where they expected it to be. But the RBNZ was a real front runner when it came to the hiking cycle.
Yeah.
But they haven't really been the front runner when it comes to easing.
No. So I think we've come from 5.5% to 4.25, and if Westpac is correct, that's another 100 basis points from the current cash rate right now. Right. Plenty more ahead. More potentially on the BOJ could come anytime now. This is Bloomberg. $1,300 on the Bloomberg dollar index. That's about a 2.5 year high. We're on a 2-year low as far as the Asia dollar index is concerned. So obviously the opposite of that as well. We are pushing though towards extreme levels given the dollar strength of late. When I say of late, of the last 11 weeks or so. The dollar yen 154.61, and the question really as it pertains to the BOJ is how much should the yen feature into really what mostly is an economic conversation coming through. And I think if you think about that from a Fed context, part of the reason the Fed was expected to cut rates the way they did overnight was simply to undo the sell-off we're seeing in the Treasury market. If they didn't cut rates overnight, they would effectively have delivered a rate cut.
And it's out.
There we go. As expected. There we go. Why did you do it? Why did you do it, Bill?
All right, I'll take the honours. Look, they've kept the overnight call rate at 0.25%. They voted 8-1 on this decision. So pretty much everyone was in line here. They are just going through their policy review now, but they have the person who is the dissenter, that was the Tamura, the member Tamura, he voted against the rate decision. But again, 8-1 decided to keep that rate unchanged. In terms of the market reaction, we're just keeping a quick eye on the Japanese yen there, but we have seen a bit more weakness looking like it's starting to come through. But let's get more with our co-anchor Sherry Ann joining us from Tokyo this morning. So yeah, it seems like pretty much most were in line on this, Sherry.
Guys, you know what I love about being in the studio today? We stayed today because it was snowing outside and it was raining. You can hear the uproar in the newsroom when the decision drops. As expected, despite the fact that it was very much expected, there was an uproar. So 0.25%, the yen weakening to 155 per dollar for the first time since November. Not surprising. And Belle, you hit the nail on the head when you talked about the BOJ board member that actually dissented. He sees upside risks for inflation rising. That was a key point that we were watching. Will we see some dissents in Governor Ueda's board, which we haven't seen so far? So what are the implications for the January meeting is the question, right? The BOJ saying that there are still high uncertainties over activity and prices. The prices will be in line with the goal in the second half of the period that they're watching right now. But as expected, perhaps the fact that we do have some political backdrop to consider with the stimulus package still being passed in Parliament. Politicians don't want to see a rate hike, not something that the BOJ can actually comment to, but that was sort of the indication and suggestions coming from analysts and economists watching the decision today, David.
This is looking, Sherry, like, I think to your point on what does this mean for January, this is looking like, I'll use that analogy of a casino, the chips being moved from, clearly they didn't move this time, and I'm looking at pricing for the January meeting in the swaps market, and we're now priced at 16 of 25 basis points. I guess the question I have for you, Sherry, is are markets correct in moving almost, not all their chips, but overwhelming number of their bets to a now likely rate hike from the BOJ in January?
I mean, the economic developments so far have been pretty strong. We have seen November core CPI surprise to the upside, coming in at growth of 2.3% year on year. We have seen the last third quarter GDP also being upgraded. So we have seen some momentum, not to mention that, of course, we had the Tankan business survey and large companies here in Japan feeling pretty optimistic. We also are getting early indications of the Shunto wage negotiations looking positive, that we might potentially see more wage hikes coming in 2025, which means that we could see potentially that demand pull inflation really taking a hold. Not to mention, of course, the implications of a weak Japanese yen. You can actually see the Bank of Japan commenting again on the yen, which is very interesting because they're now considering the FX developments more likely to affect prices than in the past. This is a wording that we have seen in the last policy statement as well, sort of a shift from the BOJ sentiment that, you know what, the Japanese yen weakness does count now, something that we hadn't seen, say, earlier this year, but that can affect inflationary pressures. And of course, the risk being that inflation could surprise to the upside as well. Right now, the expectation is for that January rate hike, as you say, as the BOJ continues to say that the cycle between wages and prices are intensifying.
The case, Sherry, I think the BOJ is laying that out quite nicely, almost on script. Can you talk a little bit more about the wage negotiations? Because it seems that we are finding ourselves in a fairly virtuous and virtuous, to be more specific, on the positive note, inflation cycle there in Japan.
Yeah, we have seen another year of strong wage growth. We have seen indications by large manufacturers, by large companies here in Japan that they will continue with those increases. We are talking about the biggest wage hikes in decades here in Japan, and that could potentially lead to workers going out and spending. Of course, a key problem, though, is the inflationary pressure, right? If we have the Japanese yen this week, it also means that households are feeling poorer. That's not really great for the overall economy. We had a BOJ board member, a former BOJ board member, Sayuri Shirai, just a few minutes ago, talking about the fact that you are seeing those wage increases, but at the same time, because the yen is so weak, you are not seeing positive real wage growth when you factor in inflation. That will be a key concern going forward, and whether or not you can move past push cost inflation coming from a weak Japanese yen to actually pull demand inflation, which is more sustainable, as the BOJ hopes to achieve. The BOJ is saying now the core CPI has been in the range of 2 to 2.5% recently. That underlying inflation is expected to rise gradually. So they seem a bit more optimistic about the inflationary pressure, but where that inflation is coming from, of course, is what's being debated right now.
Sherry, I mean, we're watching these Japanese yen moves really closely here at 155, and I know you were just discussing it there, but what do you think... What do you think we're going to get from Ueda in that presser today, and what's sort of the focus and the real watch point going to be in his comments?
It will be a very difficult press conference, won't it? I mean, we have talked extensively about the communication strategy from the BOJ really not being that effective, really wavering in the past few months, whether they think that the current inflationary pressures are correct, that if it's okay to wait. The last that we heard sources telling Bloomberg is that the BOJ actually thought that they see little cost in waiting until January, which is what set our expectations that perhaps there will be no move this time around. But how do they signal to the markets that tightening and rate hikes are coming? Because if you don't, you're going to continue seeing weakness in the Japanese yen, as you're seeing right now. We were gaining ground against the U.S. dollar just earlier before the BOJ policy decision came out, and we're now seeing downside of 0.2% and getting past that 155 level per dollar. So something that we'll continue to watch from here on out, as we will continue these discussions with our guests throughout the day. David Ingles and Annabelle Droulers in Hong Kong, thanks for setting this up for us.